Hello, everyone. I hope everyone is doing well. Thank you for joining and welcome to the 14th webinar of the CFA Emirates Society. Let me quickly introduce myself. My name is Faika Anwar. I have been a part of the asset management industry in the MENA region for over 10 years. I'm a CFA charter holder, and I'm currently working in a DIFC-based investment firm in the fixed income asset management department. Next slide. Let's quickly go over the agenda. I will talk about the CFA Emirates and then CFA Career Center, after which I will be introducing the topic and speaker for today. Then our speaker, Ron William, will take over. At the end of the session, we will have 15 minutes for Q&A. Next slide. Okay, so CFA Emirates is probably the largest probably the most the oldest in the region with over 1,000 members. The society does a lot to add value in terms of events such as the webinar today, education, career support, and communication. So in line with the webinar, we will focus on the career services, which is headed by Binod Shankar, and its scope of activities. Next slide. Starting with the research challenge, which is to help university students upgrade their skills. Last year, we made it to the EMEA finals. The Career Center is, then we have the Career Center, which is a global portal where employers can see your resume no matter where you are. It is free of cost for both employers and employees. So we highly recommend you to utilize this opportunity. Thirdly, we have the financial modeling. We have collaborations to learn financial modeling for both charter holders and candidates. We have two very important collaborations, the CFI, which provides access to high quality online courses. Secondly, we have FMI, which is an exam provider conducting the periodic exams. Fourth one on the list is communication. And as most of you already get, we send regular emails to our database on resources and events. Then lastly, but not the least, we have Career Talk series, which brings career-focused discussions touching upon both technical and soft skills, an example being today's webinar. Next slide. Housekeeping. Today's webinar is scheduled for 60 minutes. All participants are muted. We welcome the questions. You can post them in the chat box. The webinar is recorded and will be available after 1 week on the CFA Emirates website. At the end of the webinar, please take a moment to fill in the survey. And your feedback is very important to us, and it obviously helps us to bring more, it helps us to bring more sessions in line with what you require. Next slide. Okay, so without further ado, let me introduce our topic for today, which is seeking alpha in a VUCA world. I think what we are witnessing today with the most unprecedented time in recent history, this is a much needed discussion. VUCA is a globally recognized acronym meaning volatility, uncertainty, complexity, and ambiguity. It is a military term for mission critical decisions in the fog of war, unknown unknowns. The year 2020 has been marked by a pandemic, leading to shutdowns globally and a crash in financial markets, amplified by the backdrop of late economic cycles, market fragility, and socio-political unrest. Now, discussing the topic, we have Ron William joining us from RWA Advisory. He's a market strategist with over 20 years of experience producing macro research and trading strategies. He specializes in blended top-down semi-discretionary analysis driven by cycles and proprietary timing models. Ron is a behavioral finance expert, trading psychologist, and a performance coach. His primary role as part of his institutional market advisory firm, RWA, achieved global industry recognition with multiple finalist awards for best specialist research. His market insights are also featured regularly across leading financial media programs. Over to you, Ron.
Thank you very much, and a big gratitude for the CFA support at the Emirates and across the Gulf. I know there are many people in the region attending today, so welcome to everyone. it would be also good to give credit to many of the other CFA societies across Asia as well, which became part of a roadshow at the back end of last year when it was easier to travel. So it began in the Emirates, then on to Singapore, Japan, mainland China, and last but not least, Hong Kong, all on the subject of behavioral finance and technical analysis. But the big question back then was, is the big cycle turning? So certainly a big part of that cycle did turn early this year, as was originally discussed and predicted then. I'll talk about the whole meaning of that, what it actually implies in terms of our market strategy, market environment, but also the mind strategies from a behavioral point of view. And last but not least, to keep with the career development series, I will keep very focused on what this means for our professional development as well. So great to also announce that on the education front, we just launched a CFA Behavioral Finance Masterclass in Singapore, and that trend will likely continue, I think, in the new year in other regions across the world. This topic, while it's not new, the trend is renewed given some of the dislocations that we're seeing in the market and the big demand for the practical application of behavioral finance. Now, I also represent the equivalent of the CFA, but for behavioral finance, market timing, and risk management. So the world of technical analysis, and that's under the global group IFTA, the International Federation of Technical Analysts. They have their own education diploma, the CFTe diploma. Some of you will know this diploma or others that are equivalent, but essentially, if you would like to know more about that for ongoing education purposes, let me know, particularly because some of the charts I'll be sharing with you in this presentation might be a little bit overwhelming because of the overlays. So for further knowledge, it's always good to continue with the self-development. I'm also very proud to announce that this year, as part of our annual global conference, we just finished ours online. It was a great success, and we had many leading speakers from around the world sharing their ideas. So you've heard the official intro in terms of my market background, but just a quick preamble story. In those 20 years, probably the best experience I've learned is studying market cycles, cycles that existed way before I even started in the industry. But just to give you an anchor, I started 20 years ago at the tech boom bubble crash. Back then, I didn't know what a bubble was. But it intrigued me. I asked many questions, and I had the great fortune of having leading mentors, which I'll mention in a moment. As a real kind of takeaway for this session on markets and seeking alpha in a VUCA world, I think it's important to begin by talking about the importance of mentors. If it wasn't for my mentors, I would not be here today sharing my market insights. So in the old words of the UK physicist Isaac Newton, if I've seen further, it is by standing, having the great honor to stand on the shoulders of giants. And these are the three of the giants that I always like to give credit to, Mr. David Fuller, Robin Griffiths, Dr. Van Tharp, each of them with about 40, 50 years experience each, and a wealth of knowledge between them. Just to give you some clarity as to some of the insights that some of them shared and how that might present itself in my discussion, Mr. David Fuller coined the phrase behavioral technical analysis in the 1960s, before behavioral finance really became an officially recognized subject. He was an early pioneer in understanding that markets was more of a social science and better represented as a financial market ecosystem. Some of you quanti kind of geeky type might throw the tomato in the air and say, how can you say that? Surely there's an algorithm that can crack the market code. I'm here to just say, that's what makes a market. There's different views on how to study the market, but just always remember that the models can only give the best proximity to financial market reality. And always remember, it's more of a natural science based on this ecosystem analogy that was coined some time ago by my mentor. And that's based on the idea of markets driven by people or animal spirits, and hence the book that his team colleague wrote on crowd money as a real understanding of how markets function. Now, crowd money is a great way of kind of addressing this whole efficient market hypothesis theory, which has really been the bedrock to financial market work. Remember that as a rational investor, all things are usually equal, but we're not talking about rational investors or rational markets. We're talking about irrational investors when they become part of a crowd, and what happens when that crowd starts to deal in money. Crowd and money put together amplifies the irrational extremes that we see in terms of greed and fear. They produce anomalies, trends. The past behavior of trends tends to be extrapolated linear, as you can see by that mad professor at the bottom. But ultimately, it's the study of these patterns, the trading of these patterns, which is key. We need to be very aware of not being blinded by these patterns and develop behavioral biases in doing so. As a way of understanding how this crowd psychology takes form, cycles is key. And so that's why a big part of my work is cycles, based originally on the work of my second mentor, Mr. Robin Griffiths. He'd studied a lot of economic cycles as part of the business cycle, but he added a fractal pattern to it according with the technical analysis framework. And just as my third and final tribute to Dr. Van Tharp, he's a doctor psychologist that has worked with leading traders and investors around the world for some time, believing that people don't trade the markets, they trade their beliefs. So, of course, having a logical and tried and tested strategy matters, along with risk and money management. But ultimately, he believed that a lot of the decision-making process was beneath the surface of the water, the subconscious mind and the whole emotional setting that controls everything else. I'm citing books for each of these authors. So if you wanted to dive more, the book there is Trading Beyond the Matrix by Dr. Van Tharp. Now, I'd like to give you all the opportunity right at the start of this session to share. So starting from now, for the rest of the session, feel free to introduce yourselves to each other if you want to network, maybe also a little bit about your focus, a potential professional role that you have, or just markets that you're most interested in. But most important, reflect on what your goals will be for the session that you're about to listen to. Now, the question I'd like to pose to everyone is this idea of seeking alpha. The subject of this discussion is seeking alpha in a VUCA world, but let's start right at the beginning with seeking alpha. Alpha is all about the bottom line performance in markets, but it can be much more than that. Alpha can also be knowledge. Alpha can also be your edge. I want you to think about alpha as how can you maximize your alpha as a professional in your career development in this environment. This is the way that I think it would be best to platform this idea. Now, my suggestion to you is to think about alpha in a cycle, because different stages of the cycle will lead to different alpha opportunities and risk that accompany it. So my opening question, as you consider that opening statement, is what emotional stage in the investment cycle do you think we're in? Remember, the two extremes in an irrational market are greed on one side, fear on the other, and think of it as a pendulum swing from one extreme to the next. It never stops dead center in the middle. It's always a dynamic process. So we have an opening poll question based upon global markets, but let's say the most overvalued markets, Western markets in the US in particular. Where do you think we are in the greed, in the emotional cycle? Greed, fear, hope, or denial? I encourage you all to share your digital voices, click on the mouse, and join this vote. It's always great to get majority participation. I think we've just gone over the 50% mark. We're now 60%. and 80%. Wonderful. Now, what I'm seeing here is a growing trend towards hope. So let's give a few more seconds to this poll if you haven't voted yet, and now share the results. 47%, the majority, have voted for hope. In second place, greed. So we're between greed and hope. And then fear in third position. And then the minority choice was denial. So very interesting that most of you have chosen hope and greed to follow. And that's very synonymous of the market environment that we're in right now. Remember, we've just had two big uncertainties that have just been lifted. US elections, which is still work in progress, but for the most part, the winner has been proposed. Then we have the positive news from several vaccines with high safety efficacies that have been announced. So there is this sigh of hope. And of course, we're heading into year end. So many people are looking to kind of rub out the 2020 of this calendar and look forward to the 2021s where we can reset for the new decade ahead. It's not just 2021, but it's the new decade ahead. So there is this level of optimism, given that we've had some fat tail risks improve. And of course, we have the new year ahead. Now, the best way to answer this question objectively is just to go back to good old-fashioned trend analysis. Trend analysis is not exclusive to technical analysis. It can be used across the board by economists and traders, portfolio managers, and of course, even central bankers. They will look at trends as they must. And the easiest way of doing that is either by looking at it in a discretionary way or by using indicators to smooth the trend and be your guiding light as to whether it's going up, down, or sideways. Here are three trends I'm going to show you on the screen. Long-term, otherwise known as strategic, medium-term or tactical, short-term, the active time frame. So strategic, think of your 200-day moving average, the average number of days in a year. Tactical, 50-day moving average, which is your quarterly average, and 20-day, which is the average number of trading days in a month. So we're just looking at the calendar performance of 1 year, 1 quarter, 1 month. And if we look at the world, global, cross-asset, in those three phases, we can see long-term strategic, copper, India, gold are the top three. UK, France, and Switzerland are the bottom three. Tactical, India, copper, and the pound, if you're including currencies, and the yen just below. Bottom we have oil, Germany, France. And short term, the currencies have ranked up. Copper's losing some momentum, whereas we have more of the same on the downside. So what you can see is how trends develop over different cycles. You can also see when there's consistency in those trends, when all three trends are pointing in the same direction, up or down, or if there's dislocations between them. Now, the big story that I want to share with you before we go into seeking alpha in a VUCA world and the lessons from that is this idea of a dislocation in the markets, which is otherwise known as the Minsky moment. That is best explained to you through this cartoon where you have a tale of two stories. You have the Wall Street tycoon down at the bottom with his briefcase exploding full of cash because of the asset price inflation which has been taking place for most years, especially post-COVID-19 in this post-panic rally. And then on the other side, the average day person, look outside your window, who's wondering more about their job security and their living standards coming under pressure. So there's a big dislocation there. And this is part of the Minsky moment story. If you want to know more information about this theory, it is based on the work of an American economist, Hyman Minsky. The idea is stability leads to instability. So it's not that we have to be in a down market to trigger it. Often a bull market will give birth to a bear market as part of the dynamic process of cycles, but also, especially if they're fueled by speculation, additional credit, there becomes this tipping point in time which leads to deflation. This is a stylized Minsky cycle, and essentially you've got your typical sine wave rise in the market in terms of stock market prices, economy booming, GDP being positive. The issue is when we have credit reaching speculative, Ponzi, and then Minsky moment stages, it falls under its own weight. And because it's mostly a debt-driven situation, MMT doesn't save the day forever. At some point in time, markets do reverse, they do reset, and that gives birth to the new cycle. Now, this is something that I went on the record on very recently in September at the market top on the same week. We'll see if that top holds in place. But back then on CNBC Squawk Box, I spoke about markets facing a potential Minsky moment collapse. So a little bit of a doom and gloom prediction, but warranted from a risk management perspective. Many people have made money this year, which is a great thing. We also have new investors which have made it to the market for the first time ever in terms of some of those so-called Robinhood retail traders and investors. But all parties need to come to an end at some point, and a reset needs to take place in order for a healthier economy to be born. Now, the big takeaway from this discussion was a technical educational framework which I provided for the Minsky moment. So market timing was missing, and that's what we discussed in that discussion. This is the chart that was shared, and this is based on the work of my mentor, Mr. Robin Griffiths, that developed his cycle theory on the business cycle, the boom-bust cycle. And what you can see here is we are more than likely in a late stage as part of this WXY zone. I'll just highlight it there on the screen so that you can see it clearly. So W is the market top of the late cycle. X is usually the fall or the crash that happens thereafter. We saw that into COVID-19 March this year. And now what we're seeing is the post-panic rally, the so-called FOMO rally, which according to some markets broke above the record high. If you look at the US equity markets, the NASDAQ, S&P 500, and even the Russell 2000 now. So it's a broad rise in the US equity markets, but not in the rest of the world. Look at the UK, look at Europe, look at parts of Asia. They're still sideways to positive, but not record high territory. So this suggests a potential three-stage transition rollover, not a V-shaped recovery, but a rolling W retest of the crash lows to come. It's not about being right or wrong. It's just about watching the market, developing different scenarios, and ultimately positioning yourself ahead of time in order to basically be ready, whichever way the market decides to go. That's the prediction, and that's certainly a risk scenario worth keeping in mind. Now, the headlines have been all about the US elections and the vaccine rollout just recently. So I thought I'd begin on topic with this latest chart that was featured in another interview, looking at the historical analog between now and 2000, both late cycle pictures, but also same typical event risks when we had a contested election in the US. Now it's President Trump and the potential president-elect Joe Biden, so Republicans versus Democrats. But back in 2000, it was the same thing, but with two different leaders, George Bush and Al Gore. And you can see there, whoever wins in the end, and we already have a name on the list, the uncertainty of not having the official announcement, which is still due until mid-Jan, does lead to uncertainty. Markets don't like uncertainty. And the last time we had uncertainty in a late cycle market top situation in 2000, there was a drawdown of 8.5%. That is very normal given the comments I just made about uncertainty. What we now need to see is if we get more of that drawdown effect, but also if that does lead to the rollover that we saw just after the peak of 2000, which of course was the big market top. There are some important cycles coming in to the end of this year and the new year, which is another reason why this is an important market call. This is a scenario of what that would look like on the S&P 500 if it were to break below 3,000. If it holds above 3,600 on a weekly or monthly basis, then all that you hear now is neutral. This bearish risk scenario is put on hold, so you can take that as a positive message. If the market holds above 3,600 for 1 week or 1 month. Otherwise, if it breaks below 3,000, that is a big psychological level, but also it's the 2018 prior record high. From a crowd psychology point of view, what that suggests is all of the long positions that were built up since 2018 get locked. And it turns into what we call a bull trap. So a lot of the long positions get squeezed, market rolls over, and this is one of the most effective reversal patterns. The other reason why that is it is important is because of the psychology in this pattern, this exhaustion pattern, which is a pattern of higher highs and lower lows. What that means is you have an increase of buyers and sellers both fighting until the very end of this pattern, increasing volatility, and certainly maintaining more of a disagreement between the two, and ultimately that pattern does reverse to the downside. There's various statistical analysis on the left just showing equilibrium points on the chart, but also price gaps, and just down below some cycle studies and just a volatility indicator just showing the overbought nature of the market. I'm going through this quickly just to give you a quick perspective, but all of this will be available to you post-session. So by all means, feel free to look at the notes thereafter for more details. Now, one of the big reasons why I think it is a concern to look at the other side of the trade is because of the FOMO trade, which seems to be overdone. We could still see further upside in the market, but the issue is the pendulum swing from fear to greed has been extreme. So this is a chart of the options market, the proxy for long positions versus short positions, but as expressed in the futures market based on option contracts. And what that shows is back in March, this white line had peaked up, which was the level of put volume exceeding call volume, so more bearishness and fear in the market. That pendulum swung the other way in June onto August and September from fear to greed, when we had the opposite, call volume exceeding put volume. And essentially that was extreme leverage, mostly in the tech names, and just across US equity markets in general, as the FOMO trade took hold. Now, the best anecdotal example of that was published by the Financial Times based on a tech Japanese firm called SoftBank. They took a $4 billion position on US stock options, some single name as well. I'll say that again, $4 billion, that's the notional amount, not the net impact. And this chart here on the right from Bloomberg just shows the extent of the tech rally or FANG divergence in terms of the tech stocks, Facebook, Apple, Netflix, and Google, that were really the winners in this K-shaped recovery. Winners versus losers. Tech did very well post COVID-19 crash. And so that skewed the market. And because these tech stocks have a great weighting in the index, then we're really seeing tech win as opposed to the broad-based move in the market. And that's the concern. Now, in terms of volatility, the best signal is to look at the VIX chart. This shows volatility, but it also expresses behavioral psychology in terms of fear or complacency. Anytime you see spikes, it's fear. Anytime you see a drop to the bottom, it's complacency. And ever since 2016, I've been highlighting to many of my clients, students, and just general industry discussions, this compression pattern that's been taking place on the VIX, which was a good predictive pattern for mean reversion setups. So what we see here is high volatility leading to low volatility, and that repeating itself again and again and again. And it's very counterintuitive. You need to be countercyclical. You need to be adapting to the changing environment and not getting fixed in hindsight bias. So what we can see here is there was a 3-year compression pattern right at the beginning. That led to the spike in early 2018. Remember, that was the volatility margin call, a trade that was bigger than FANG, BANG, and Bitcoin put all together, where a lot of people were looking for a free lunch and realized that these things don't last forever. Then at the end of the year, we had some of the best trades, momentum stocks fall from grace. So we had an echo move of what happened before. And then this continued, basically. You can label it whichever way you want in terms of what was the event risk, but essentially this pattern continued until the spike into the pandemic event. And now we have this range between 40 and 20. Watch out to see which way that range breaks. The question mark there is this a new calm before the storm? If it isn't, the VIX needs to break below 20. Otherwise, any move above 40 is something to be cautioned about. And if you look at the top left-hand chart, you can see this is option pricing going out into the future, showing that the market has been charging a high premium for volatility contracts going on for 2 to 3 months. So it's not that people were concerned about the election volatility on the month of the election. It's actually going into year end and the new year that people are still concerned, particularly with this new wave of the pandemic, economic lockdowns, and any other uncertainty that might be coming up. There is still some hedging going on at the moment. Now, the flip side to all of this, in terms of what's a good potential investment opportunity, continues to be the safe haven ideas. So this is gold, still having a golden opportunity to 2,400. The trend is your friend, 20 years up, and recently it had this accumulation base pattern for 6 years, which doubled and now might triple in value. The takeaway there is the bigger the base, the higher in space. For those of you who are gold bugs, that's clearly a positive story, but just keep in mind that gold can spike. And this is the analogy similar to the 1980s, where it's a crisis or fear hedge, not an inflation hedge, a crisis or fear hedge. And so it's a good run to make in terms of absolute performance, but just be very aware of what it means from a sentiment play in terms of the crisis fear hedge, but also in terms of the exit strategy that will be important if it is a spike situation. And then lastly, of course, Bitcoin is the digital gold of our era. And many of you younger CFA members will probably support that view. We can see here there's a very big breakout in Bitcoin. This is not up to date. Bitcoin is actually further up on that chart and looking like it's going to make a new high breakout above the record highs of 20,000. So watch this space as this one-year base looks to extend higher. Okay, so our second question is, what does volatility mean to you? This is the essence of our discussion today. I just gave you a market roundup just to set the scene. What does volatility mean to you? So we have three options here: risk, opportunity, or uncertainty. Risk, opportunity, or uncertainty. Now, I'm going to give you a little bit more time just to click on the mouse. Again, share your digital voice and let's get a majority vote. 80% have voted, so we have more than enough of a majority. Let's share that result. And what we see here is 53% of you, the majority or just over, chose uncertainty as what volatility means to you, you or your clients. Or your career development situation. 33% of you in second place say opportunity, and the remaining say risk. That's very interesting. I've done this poll all year round, and I've got different results according to the different times I've asked this question. And of course, also it does change depending on who's being asked the question, but very interesting to see that result. I'm just going to share it again, just to make sure you can take a screen check of that. Interesting results. Most of you chose uncertainty. Now, the answer that you all gave me there, a mixture of each of those options, is going to be key, because that ultimately decides how you position yourself in this market. And so these are the wise words of my third mentor, Dr. Van Tharp, the leading trading psychologist, that believes that people don't trade the markets, they trade their beliefs. Think about that. They don't trade the markets, they trade their beliefs. And so of course, we do use active strategies, but the point is our perceptions, our beliefs in the market and about things like risk, opportunity, and uncertainty will have a big amplification effect in terms of how that translates into a strategy. So be aware of that 80-20 rule. If you're too risk averse, you're likely to get stuck into loss aversion, behavioral biases. If you see crisis as an opportunity, then you'll be the entrepreneur of this time. Warren Buffett is a great example of that. Back in the World War II years of learning the value investment benefits, just when stocks were bombed out, and there were people fighting tragically around the world. Uncertainty is the nature of volatility. And so for those of you that chose uncertainty, which is the majority, I want you to keep in mind how, ask yourself, how do you perceive uncertainty? There are many people I work with that are confident about uncertainty. They understand it's an anomaly. They know it's unpredictable, but they mitigate that risk of uncertain outcomes through different strategies. So how you react to in uncertain times from a market or mind strategy really matters as an investment professional, career development perspective, or just in terms of the strategy that you use. Now, in the East, where I've spent some time, especially in the last few years, I got to travel across different countries, as you mentioned, as I shared there at the beginning. It included a CFA roadshow in Japan, Singapore, Hong Kong, and mainland China. In China in particular, they have this beautiful philosophy about a crisis opportunity. In the Chinese language, the word danger looks exactly the same as the word opportunity. It's just a different stroke, and one can mean the other. And this was made popular by the former American President John F. Kennedy back in the 60s during the Cuban Missile Crisis, a real crisis era, where he said, the Chinese use two brushstrokes to write the word crisis. One brushstroke stands for danger, the other for opportunity. In a crisis, be aware of the danger, don't ignore it, but recognize the opportunity. So the idea is not to be blindsided to either the danger or the opportunity that follows. And this is part of their philosophy of duality in life and in markets as part of the yin-yang symbolism. Now, to extend from the volatility point, we must also encapsulate this acronym, which has been reborn. It's not a new term, it's actually an old term, as was just introduced at the beginning there, VUCA. VUCA means volatility, uncertainty, complexity, ambiguity, and it was originally formed out of the US military as a way to recognize a new type of war, which required a new type of strategy. And later on, it was adopted by business and financial market professionals because they saw that disruptive times was basically the VUCA paradigm, and one that we really needed to better understand and get a handle of. And so certainly VUCA has been reborn this year, given what's happened. Now, the VUCA situation, we need to recognize this idea of fat tails and black swans. We can no longer live in the efficient market hypothesis world. And I say that respectfully. I know there are three versions of the EMH theory, and each can subscribe to whichever theory they want. But the market reality is that markets move in a leptokurtic statistical distribution. And all that means is high volatility or big sigma events and the black swans that follow, black or white, happen more often than we might realize. Think about the market volatility that has happened for years and years and years. Now, this is the proof, the practical evidence of the theory. And here we can see long-term cycles over 100 years of price data based on the US equity market. That's the black line pointing up with the regression band showing you the trend. And what we see here is long-term cycles that alternate for generations of 16 to 20 years. If you look at the right of the slide, you can see the key takeaways there. Now, during the uptrending cycles, strong trends exhibit relatively low volatility. The optimal investment strategy is passive buy and hold. So it's probably just best just to trade the index or just focus on the passive strategies. But here's the key insight. When there's a shift in market regime, you've got to change. You've got to change the market strategy. You've got to change the mind strategy from a behavioral point of view as well. Alternative market regimes trigger higher volatility, more event risk, and ultimately active management does come back into fashion as part of a rotation theme, and risk optimization becomes key. Now you can see here at the bottom, these are the event risk: coronavirus, 2008 global financial crisis, Y2K, 1987 crash, 73 oil shock, 1929 crash, and then last but not least, the 1907 bankers' panic that led to the creation of the Federal Reserve. So that's just a walk down memory lane in terms of event risks that have happened over the last 100 years. But each of those event risks, most of them took place during bear cycles. The only exception is 1987, which happened in the mid-stage of a long-term 18-year bull market. Strong economic growth, low unemployment, and the laissez-faire kind of policy effect. What this all suggests now is that there's a potential reset this year going on for the next few years. That is traditional. And this is the data analysis behind it. Remember, as part of my cycle framework, I do dig deep and really look for confluence of data. And what we can see here is multiple cycles all creating a tidal wave impact during that 2 to 3 year period. And that just shows that there's a rotation, there's a reset taking place. It's not the end of the world, but certainly a time that we need to be aware of ongoing disruption and a potential crisis opportunity for those who can position themselves for it. Now, one of the key things I want to encourage you to do, and you've heard me say this already, is scenario plan. This is not something that I've developed. This is actually made famous in the energy sector. Back in the 1980s, I believe Shell became very successful in identifying oil and energy deposits through scenario planning. They actually developed a think tank group just for scenario planning. And I have an energy friend of mine that shares these stories with me on a regular basis. So scenario planning is not just important for the energy world where there's a lot of high risk and uncertainty, but definitely for business and for finance. Now, I want us to practice scenario planning based on risk situations. So I'm going to give you a risk simulation. Think of it as a stress test based on the asymmetric risk that may likely happen over the next few years. So I'm going to give you an option of 3 bear scenarios. The first one is called good, the second one is called bad, the third one is called ugly. Named after the Western American movie, The Good, Bad, Ugly, starring Clint Eastwood, for those of you who are cowboy fans. Please vote on your next poll, which is going to appear. Do you believe that we're going to have a good scenario, which is a V-shaped recovery, a bad scenario, which is a hybrid of a U to W-shaped recovery, or do you think that it might be ugly, where it's an L-shaped recovery, anything like the 1970s or the big old 1929. I'm throwing it out all on the table there so we can just be very honest with each other and ourselves and just mitigate a risk, scenario plan. It's not about being right or wrong. It's just about considering different optionalities. So we can see here, majority of you are choosing bad. 70% are choosing bad. So although you're optimistic and you chose hope and greed at the beginning, in terms of the risk mitigation and scenario planning, most of you, 77% of you, are choosing bad. 15% are saying ugly, and then the remaining minority is ugly. So is good. I'm going to share that poll now, so you can all see it. Bad is the majority, 80%. This is actually, sorry, 79%. This is the biggest majority vote that we've had. So clearly, I think most of you are more concerned about the risk than the reward. And you're looking for a U to W-shaped recovery. Now, let me just explain. A U to W-shaped recovery is a minimum of 50% drawdown. And the time repair period for the market to reset is 1.5 years to 3 years, not just a few months. This V-shaped recovery literally was just a few months. So that would make sense if you believe this V-shaped recovery is false and about to roll into a W or U-shaped recovery, then the few months it took for the market to recover will extend a little bit more. I want you to consider VUCA experiences that you've all had. Type it in the chat just so that you can kind of share it with each other and just consider for a moment what that VUCA experience was. Think about the pandemic, think about the lockdown, think about disruptions to your career. What was the VUCA experience and how did you deal with it? I think it's a good opportunity for all of us to learn from each other in literally a minute or two just before I wrap this presentation. Please share in the discussion if you'd like. Now, on the behavioral side, I want to mention how volatility influences your mindset, and then we wrap up for the Q&A session, which I'm really looking forward to. As part of the behavioral finance component, which I'm a big supporter of, it's really important that we understand the softer side of volatility and what it does to our mind, bodies, and emotion, and ultimately how we react in the market. Now, it's all about the brain and the lizard brain more specifically. And this is a survival program that has been developed since ancient times. I like to explain this point in more detail in behavioral finance workshops, but essentially it's an ancient mind trying to live in a modern world. And we have the issues of some of the behavioral biases, but some of the tech issues. Keep in mind that your brain is a muscle, and if you actually practice mental strategies, it can be further enhanced. But if you don't, it can dwindle over time. There are various cognitive biases, which I won't go into now, but the big ones are loss aversion. Pain is greater than pleasure. It's twice as great because of that survival program. Overconfidence, or FOMO, is great, particularly for those that have a strong background in markets, or they've just had a good winning streak. But ultimately, the three strategies which I want to end with is these ones for you to take away with you: resilience, divergent thinking, and optionality. Resilience, divergent thinking, optionality. These are the different options here on the screen. I'll leave with you as we end our discussion. Markets, think of the all-weather investment process with active market timing, risk money management, and mind, the greater self-awareness. We need to be able to reduce our behavioral biases by first identifying them, but also dealing with the stress that I just mentioned. Divergent thinking is all about probabilities, not certainties. So avoid linear one-way bets, hedge outlier, black or white tail risks. And then finally, optionality is my way of talking about scenario planning based on learning from past anomalies. It's not about looking at the normal times. You need to be looking at the anomalies to understand some of the patterns that might take place. My final slide is, this is what happens in a volatile market. The data shows that cash, gold, and some of the safe haven currencies tend to do well. And if you are able to mitigate the peak to drawdown risk in a multi-year time frame, there is light at the end of the tunnel, but you need to mitigate the risk through active management and general risk money management. And my final thought is the essence of investment management, in the words of Benjamin Graham, the grandfather of fundamental analysis and value investing, is about the management of risks, not the management of returns. So I'm going to challenge you all to think in terms of risk-adjusted returns. And thank you all for being patient and engaged in my session. These are recommended books for behavioral finance, technical analysis, and this will all be available in handout slides for you to continue ongoing education. And if you'd like to stay in touch, here's my email address. I'm happy to send educational material, but also a report if it's of interest, and social media contact if you want to stay in touch.
Thank you, Ron. That was very enlightening. And I guess the questions will start flowing through. For now, anybody who has a question, please feel free to post in the chat box so we can take it up here. I will begin with one. I have a few to start off with. Firstly, the valuations that we're seeing in both equity and credit markets, is it because of the greater access and affordability of financial products available to the retail investors? And if that is the case, then how should asset managers navigate the investment landscape and accommodate the new reality in the investment thesis?
Great question, and I'm glad that we have this Q&A section because I think it brings all of this to life. It also gives a moment for everyone to think outside the box. Certainly, the new wave of investors is a new norm reality, but it's not the only one. I think that the bigger wave is central bank intervention at record levels. I don't have the chart here, but the latest figure was in the trillions, and that was all in just one quarter. So the asset price inflation created by central banks in order to mitigate the risk of this pandemic panic is morally important for the short term, but a long-term price that we might need to pay in terms of inflation risks or or just crisis situations. But yes, at the margins, new investors are here. Generally, that's a good thing. And particularly, most of those investors have made money during the FOMO rally. My concern is for that new wave of investors to continue their learning curve experience, because if you make money on your first trade, most PMs will tell you it's not the best experience, because you tend to think that markets go in one direction, and adapting to volatility becomes a problem.
Okay, so just to follow up on that, so when they do take their foot off the stimulus pedal, what kind of volatility do you expect?
Well, so the tapering risk is a real one. And I think if you combine that with some of the just systemic risk that might come back online, particularly with the big elephant in the room, which is solvency issues, different people subscribe to different theories. I think there are people that take the other view that MMT is here to stay and will save the day. I don't agree with that. That belief. I think central banks have done their best, but they're out of ammo, and ultimately Mr. Market will decide how to reprice, and it already is. Look at the dollar depreciating in value 10% year to date, likely to go down even further, I believe, in the next year or two. Gold is telling everyone that currencies are being debased, and for that reason, we have an extension of a 20-year uptrend, and even Bitcoin's getting a little bit of the safe haven flavor for the same reasons. So I think we're already seeing Mr. Market vote with its feet against some of this asset price inflation, and also because they're shifting into tangible hard assets to try and preserve their capital. The problem is going to be timing. We'll see, I think, particularly in the US, how the US election outcome finally ends. Not so much to see who wins, Biden or Trump, but to see what that does in terms of the political deadlock in the Senate and in Congress, and what that will translate to in terms of further spending for the US economy and maybe the rest of the world. You may have heard on the newswire just now, they have stopped extending support for the mainstream economy beyond the end of December. So that's like taking the lifeboats away from the Titanic at the wrong time.
All right. While we were still waiting, if it's okay, I can ask. I have a couple of more questions that I would like to ask. So one thing is, firstly, and it's a related question with where we are right now with the current scenario, where historical correlations are no longer working. What advice do you have for investors?
Yes, so I think the correlations have worked for a large part of the FOMO rally, because it's been the everything bubble, where everything that is asset price led just rose up at the same time. Correlations went to 1 + 1, but that reality has an opposite equal. So when markets flip from up to down, you'll see correlations go from +1 to -1, and that's the issue. So having some kind of diversification, which I must differentiate between diversification. We need to be very careful in terms of how we play correlations on the way down. And so smart diversification is recommended. The work of hedge fund manager Ray Dalio's is actually quite good in this area. He's published quite a lot on having an all-weather portfolio. And he also has interesting views about cash. Good some of the time, but not all of the times, and maybe there might be alternative safe haven plays to keep in mind in a down wave.
I think something's come through. Just let me have a look if it's a question that's come our way. No, I think somebody just put a comment on their views on what's happening around the world. So I don't think there's a question. Then I have one last question, which is, obviously you discussed the FOMO rally, and we are being led increasingly by behavioral biases in the market. And I think most of us are guilty of jumping on the bandwagon due to this FOMO rally. How do we reconcile this behavior with a plausible investment thesis and maintain investment discipline?
It's a tough one, and I think it's the challenge of our current market cycle. FOMO is profitable. I'll say that again. FOMO is profitable, and that's the problem. So I've received a whole lot of pushback from good friends of mine in the market that are taking the other side of my risk view, and that's what makes a market. But we always respectfully conclude in that that's the dynamic at play at the moment, and that's part of the tipping point. So in a way, as investors, but also as those that are maybe involved in relationship management, when you're engaging with people wanting to manage money, we need to follow the trends. We need to continue to share the profit bottom line with the market. But I think it's the level of risk. It's the risk premium that we need to be very concerned on. Right now, there's a big chase of yield, partly because interest rates are at historic lows. That will likely continue for a while, but not forever. So I think how we handle the risk is probably the better point. And that's hence my last message about risk-adjusted returns. And I'll just show you this last slide, which I had included. This is the model that I work on from a behavioral finance point of view. There's quite a lot there. It'll be available in the handout slides, but essentially the 3-stage pattern is awareness, change, and then ultimately sustained transformation. The way around that is through behavioral finance, neuroscience, which is, I think, even more useful from a practical point of view. Resilience and coherent strategies. This is the roadmap that I've developed over the years. But all of this requires an understanding of the nature-nurture paradigm. So biological survival effects that we have in terms of what I shared with you, but then also the perceptions that we have as investors and traders.
Okay, so some of the questions, thank you so much. I did have an additional question, but I'll stop right there. We have 2 other questions that have come through. One of them is, what do you think about volatility management strategies during this uncertain environment?
Yeah, I think this is a boom market for volatility strategies. And I spoke to one of the well-known names in volatility indicators, Mr. John Bollinger, who spoke to me about how he developed his indicator back in the 1980s, just after a 16-year bear market during the 70s. And it was the same thing then. The Nobel Prize winner back in the early 1980s was for a volatility model. This gentleman developed a volatility indicator. And I think we're back then in terms of the study of the same tool. I think there's room for looking for mean reversion strategies, seeing how that affects the portfolio, stress testing, scenario planning, but ultimately how we manage risk is going to be key.
Okay, I know we're really short on time, but I think 2 really good questions have come through. One of them, as fixed income asset management, it does apply to me. I'll take that after, but there's another one in line with what you've said. I think I'll take that first. It says, if we would have done risk management effectively, don't you think we would have missed the entire rally from March 23rd onwards? Don't you think the best strategy sometimes is just to sit tight?
I think if you have a good handle of stage of the cycle, yes. The trouble is if we believe that markets are linear, then we get into trouble. Not only do we develop dangerous behavioral biases, but we tend to take on too much risk. So it's not about sitting tight on the roller coaster ride. That can be good, and certainly late cycle, that's when we can make the most amount of money. It's about knowing when to exit, knowing when the risk is too high a risk. And so for some hedge fund aggressive type strategies, that's their playground. But I think for the mainstream investors, and certainly those that have more moderate risk profiles, I think it's better to be prudent. I do agree that just being a contrarian for the sake of being a contrarian is not recommended. But certainly at least being aware of both sides of the trade, having a risk scenario in mind will be useful. You can still bet the market up, but have a risk scenario just in case. And that's the main point. That's the beauty of scenario planning. It's not about being right or wrong, and it's not about having any certainty. It's about working with probabilities. So even if you think 80% market's going to go up, there's 20% saying the market might go down. At least that way you're thinking laterally. And the way I describe it as lateral thinking, you open up your eyes, you look laterally, as opposed to this 20/20 vision where we've just got this tunnel vision. So in a very short space of time, that would be my recommendation.
So just last question. I'll actually club the 2 when I said the one that affects me directly as fixed income asset management. And then there's another person who's asked, again, for the region. First is, how would you manage the bond portfolio in this current environment? And sort of we can sort of club it together. And the other one is, what do you find, or what do you think about investment opportunities in the MENA region?
Yes, so great question, and I'll have a stronger answer on the first point. The big bond cycle is at a turning point, but it's a multi-year turning point. Often these cycles take time to turn. So long-term yields will likely stay down and be negative, even in the US maybe in the new year. But at some point in time, we will go from deflation to inflation. I think we're 3 to 5 years off from that. As evidence behind the theory, this is long-term cycles on US bond market going back 200 years. You have to go back that far to see it in motion. The projection I have is for 2022 plus or minus 1 year, and the normalization is 5%. Even if you discount that to 4% or 3%, that's still a big shift. And with the debt situation that we have, many of the bond portfolios are going to get hit hard. So I think the recommendation would be to focus on quality and some kind of a safe haven diversify play. And the event risk I would highlight is a potential deflationary spike in yields, which happened in 1931 and 1937. Ray Dalio, hedge fund manager from Bridgewater House, also has a similar thesis. That still is down for yields in the short term, and then the long-term shift. But that spike does create an issue, I think, for your bond portfolio question.
And the MENA region, just quick take on it.
I think any of the disruption opportunities, so that might not be unique to the MENA region, but certainly energy over the long term. I think any demographic play in terms of some of these disruptive industries, which are supported by young demographics, the digital space, also in terms of industry and career development, machine learning, AI, I think all of these things will take off as part of this accelerated change that we're seeing. But in terms of asset class specific, I would say gold, energy in general over the next few years. The Middle East has strong demographics, which I think is good for when the cycle resets. And in terms of industries, the digital space and just the general tech space, I think will continue to boom.
Thank you, Ron. Again, it was a great presentation. Thank you for answering all the questions. Can I just request you to put your contact details once more so that our participants can take it down? Just a reminder, please fill out the survey. It helps us, bring sessions more in line with what you're looking for. And if we haven't answered a question, or if there's any further questions, you can reach out to Ron on his contact details are given there. The webinar will be available within 1 week on the CFA Emirates website. Thank you. Thank you, everyone, for joining.
Thank you very much.